Hey good people, welcome to today's video as we continue our series how to trade forex. And today we're going to talk about lots, brokers, leverage, and maybe talk about margin. I'm Nick, I'm a forex trader and I'm the founder of Optimal FX Trading Made Easy. Let's go. So let's talk about lots. Maybe you've heard about lots, maybe you haven't. No problem. So by definition, a lot is the number of currency units you will buy or sell. It is best to always convert any number of units you buy or sell in lots instead of thinking about them as mini lots or micro lots. Yesterday we talked about a standard lot, mini lot, and micro lots. Now, usually it's very difficult for you to keep talking about mini lots and micro lots. So, to make it easy, we always convert every number of units you buy or sell in the market to lots, right? How do you do this? It's so simple. It's simple maths. All you have to do, because you already know that one standard lot is equal to 100,000 units. So all you have to do is divide any number of units you buy in the market or sell in the market in that case by 100,000. Okay? Right? So every number of units you buy, just divide that by 100,000 and you get the number of lots. For example, if you buy 10,000 units, convert them to lots instead of thinking about them as one mini lot. So that will be 10,000 divided by 100,000 and you get 0.1 lots. You get it? So how to calculate lot size? Always divide the number of units by 100,000 units. Okay, and here, by the way, the SI units are very important. Okay, you have to differentiate between units, lots, yeah, pips. So that is very important. So one lot is equal to 100,000 units. Therefore, any number of units divided by 100,000 units is equal to a certain number of lots. For example, 25,000 units will be equal to 0.25 lots, and 50,000 units will be equal to 2.5 lots. We good? Perfect. Now, let's talk about brokers. What is a broker in Forex? What is a broker in Forex? Right? Yes, so by definition, a Forex broker is a financial service company that provides traders access to a platform for buying and selling foreign currencies. To make it simple, think about brokers out here, right? Let's talk about car dealers or property sellers in real estate. Mostly, you'll find brokers in those industries, right? And a broker is just someone that will link you, the buyer, to with the seller, right? The owner of the house and the buyer. There will be a broker in the middle, right? So what happens? You see, in early years, um, for you to be able to trade forex, you'd have to have a lot of money, and not just that. For example, you know about Nairobi Stock Exchange, right? Maybe you've heard about New York Stock Exchange, London Stock Exchange, and so on. So, for you to be able to trade forex, you'd have to be in an exchange physically. So, for you to be able to trade anything in the US, you'd have to be in the New York Stock Exchange. Yeah. But now with brokers, they make it possible to link the New York Stock Exchange right in your laptop, right? So you can do everything in your laptop or in your machine or in your phone at the comfort of your house, yeah, traveling anywhere in the world, you can trade. So brokers make that possible. Okay, that is what we mean by brokers in forex. A forex broker fills in the gap between the stock exchange and traders. They act as an intermediary. Okay, so we have different types of brokers. Actually, we just have two. Okay, we have A book brokers and we have B book brokers. Okay, so When we talk about ebook brokers, what we mean is they use something we call STP or ECN. STP stands for straight through processing, and ECN stands for electronic communication network. So what does this mean? What it means is when you are using A brokers, right, there's no conflict of interest. What do I mean by this? You see, let's talk about B brokers first. So B brokers, they act as the market makers, or rather the liquidity providers. We'll come to learn about this way on. So when we talk about these brokers being liquidity providers, what we mean is when you lose a trade, they win. And when you win a trade, they lose. So there's obviously that conflict of interest, right? So instead of these brokers just making money from what we call spread or maybe commission, they actually make money if you lose. So if that is the case, then that means the brokers will not be rooting for you. They actually want you to fail. Yeah. But when you talk about e-book brokers who deal with straight through processing and electronic communication networks, now there's no conflict of interest whatsoever. Why? Because these brokers, they don't act as liquidity providers or rather the market makers. So you'd ask, so how do they place your trades? What they do, they connect the traders straight with other liquidity providers, and this makes the trades be executed so fast. Okay, and also they have narrower spreads. Okay, we come to learn about spreads and everything else way in the series, but right now I just want you to understand that ebook brokers, they link you with other liquidity providers. And when they do that, that means there is no conflict of interest. Yeah. So if you lose money, or rather, if you lose a trade, they don't care. If you win a trade, they don't care. What they care about is they, or rather, how do they make money? They make money from commission. They charge you a commission per trade or spread. Okay, so think of commission and spread as when you pay, when you send someone money through M-Pesa, there's that transaction fee that you are charged, right? Per every transaction you send, you are charged a certain fee. That fee is the same fee in Forex. That is what we call spread or commission. Okay. Now there's still a difference, sorry, between STP brokers and ECN brokers. So if a broker uses STP, yeah, they accept to gain money or rather to be paid via commission or spread. But when you use ECN brokers, they solely use commission. Okay, they don't need spread. They just make money from commission. So you agree the commission that you'll be paying per trade. So if you agree that you'll be paying, let's say $5 per standard lot taken, that is the money they'll be cutting you, and it's usually in terms of a drawdown. And we'll come to learn about that later in the series. So I hope you guys understand now brokers and the different types of brokers and how they actually works. I had something back not long ago actually. There was a certain broker. I'm not going to mention the name, but there's a certain broker in Kenya. Maybe we'll mention that when we do a specific video about brokers. So there's this certain broker in Kenya who manipulated the market, and people lost a lot of money. It was a bloodbath that day. People lost so much. The market moved like 100 pips in just a few seconds, and people were complaining. Accounts were blown. People lost like 10,000 of thousands of dollars. Yeah, and it was brutal. So it's very, very key for you to choose a good broker. Usually, I trade with a broker called BD Swiss, and I'll come to mention that later. No worries. So for now, let's move on to leverage. Leverage. Yes. So when you talk about leverage, think about leverage as a loan. So by definition, leverage in Forex is like a loan that the broker gives the trader so that the trader has more capital to trade with than what he or she initially had. Okay. So Let's go back to earlier days. Earlier days, what would happen is for you to be able to trade, you'd need a lot of money. Reason because we talked about units and how we convert those units into lots. Now, one unit, let's do some simple math. One unit is usually equal to $1. So for you to buy 100,000 units, which is one standard lot, you need how much? $100,000. Now imagine right now, do you have $100,000, which is like dollar trading at 160? That's almost over 16 million, right? So for you to be able to trade in earlier days, you'd need to have 100,000 units, just $100,000 just to trade one standard lot. But right now, we have brokers offering us leverage, which is like a loan. So once you get this leverage, what you do, maybe let's say you have $1,000 account and your broker, and right now every broker in Kenya licensed by CMA, Capital Markets Authority, they have up to 1:400 leverage. So let's say you take 1:400 and you have $1,000 in account. That is $400,000, which means you can take up to 4 standard lots. You see, but with your $1,000, if it were in earlier days, you take what? A micro lot. You see? So so if you take, let's say, one standard lot and you have 1:400 and your account has like $1,000, you see, you can take your standard lot and still remain with enough buying power that you can use to take other trades. So leverage in Forex is expressed as a ratio. For example, a broker can offer 1:100 leverage. This means you can trade units 100 times the amount you have in your account. If you have $100 in your account, you can trade with $10,000. Leverage simply gives you more buying power, what we call BP. So let's talk about how to use leverage to our advantage. Yeah. So, how to use leverage to our advantage? Leverage trading can be dangerous, very dangerous. When using leverage, you can easily lose all your money. This is because leverage magnifies your losses or your profits. In an instance where your trade is wrong, you might lose a lot of your capital. Leverage trading should be applied when you are sure that the trade will play to your advantage. Also, calculate the potential loss if the trade is wrong. We'll learn more about this in the risk management class. Yes, so let's do some simple maths here. What do I mean when I say that leverage can be dangerous? Yeah? So, for example, let's say you have $100 in your account, right? And with your broker, you took a leverage, which is the maximum leverage, 1:400, which brings your buying power to what? To $40,000. With $40,000 divided by 100,000, that brings us to zero point 0.4 lots, right? With zero point 0.4 lots, you'll be losing or you'll be making $4 per pip. Yeah, we did pips yesterday, so I hope you guys still remember. So you'll be making or losing $4 per trade. Now let's say you have let's say the trades moves, your stop loss rather is 5 pips. So when the market moves 5 pips against your direction, right, you'll be losing $20, which is 5 times 4, $20. But let's say you took a lower leverage, which is, for example, 1:100. With your $100, you'll be having $10,000, which is zero point 0.1 lots. With zero point 0.1 lots, you'll be losing or making $1 per pip. So if your stop loss is still 5 pips, 5 times 1, that is $5. So in the first one, when you took maximum leverage, you're losing $20. But in this one, because you have lower leverage, you're losing only $5. So guys, that marks the end of the session, and I hope you guys enjoyed it. I hope you learned something. Yeah. So have a nice time.